At the very heart of modern finance, there is a fundamental conflict. On one side, we have standard financial theory, which assumes that we're all rational investors operating in perfectly efficient markets. And on the other, we have the field of behavioral finance, which argues that, well, investors are human, and our decisions are often driven by emotion and cognitive bias, not by cold, hard logic.
This brings us to the central question we're going to explore today. Are financial markets the flawless, information processing machines that traditional theory would have us believe, or are they something else entirely? Dynamic systems that are profoundly influenced by the predictable and sometimes irrational patterns of human psychology.
Our journey through this topic will unfold in 5 parts. We are going to start with the classical theory, the efficient market hypothesis. Then we will introduce the human factor and look at some of the costly psychological biases that can affect investors. After that, we will explore a newer theory that helps to reconcile these two opposing views, which will lead us right to our conclusion, a practical framework you can use to become a more rational investor.
So, let us begin with the bedrock of traditional financial theory. It is crucial to understand the efficient market hypothesis, because it really provides the theoretical baseline against which all other market behaviors and theories are measured.
The efficient market hypothesis, or EMH, was developed by Professor Eugene Fama, and it posits that security prices reflect all available information almost instantaneously. Now, the conclusion of this theory is both powerful and pretty controversial. It suggests that no amount of analysis, no matter how sophisticated, can give you a consistent edge. The only way an investor can expect to earn higher returns is by taking on a proportionally higher level of risk.
This hypothesis actually comes in 3 distinct forms, each one building on the last. The weak form argues that all past price data is already baked into the current price, which would make technical analysis useless. The semi-strong form takes it a step further, claiming that all public information, news, reports, everything, is also reflected, which would neutralize any edge from fundamental analysis. And finally, the strong form asserts that even private or insider information is already priced in, which suggests that active portfolio management itself provides no real value.
Now, if markets were really that perfectly efficient, then things like market bubbles and sudden crashes shouldn't really happen. But as we know, history shows us they do. This brings us to the compelling counterargument, where the field of behavioral finance introduces that unpredictable and often irrational human element into the financial equation.
And this is where the two paradigms really diverge. You see, standard finance operates in an idealized world of rational actors and efficient markets, where prices move in an unpredictable, random walk. Behavioral finance, on the other hand, looks at observed reality and sees normal, emotional human beings whose predictable psychological errors can actually create detectable anomalies in market prices.
A true cornerstone of behavioral finance is an idea called prospect theory. It explains that when we make decisions under uncertainty, we are not driven by absolute outcomes, but by the psychological value of potential gains and losses relative to some starting point. This entire framework is really built on 2 key concepts: mental accounting and, most importantly, loss aversion.
Let's consider this first scenario. If you present this choice to most people, they will choose option A, the certain $1 million profit. And they do this even though option B has a higher mathematical expected value of $1.1 million. This clearly demonstrates that we are inherently risk-averse when we have a sure gain on the table. But watch what happens when we reframe the decision around losses. Faced with these options, most people suddenly flip their behavior and become risk-seeking. They will choose option B. They are willing to risk a much greater potential loss just for the chance to avoid a certain one. This reveals a fundamental and, frankly, irrational asymmetry in how we make decisions. This quote right here captures the very essence of prospect theory. The psychological pain of a loss is felt far more intensely than the equivalent pleasure we get from a gain. And this simple but profound insight explains our tendency to take on much greater risks to avoid losing money than we do to make it. This brings us to some of the specific psychological traps that stem directly from our human nature.
Simply understanding these biases is the very first step toward reducing their negative impact on your investment portfolio.
The first bias is called mental accounting, which is our tendency to treat money differently depending on where it came from or what we plan to do with it. Now, for an income investor, this is particularly relevant. Many investors place a huge premium on dividend income, but they view generating the exact same amount of income by selling an appreciated stock as dipping into principal. Financially, of course, a dollar is a dollar, but psychologically, we build these walls between our accounts.
Next up is the disposition effect, a behavior that is driven by the very powerful emotions of pride and regret. We tend to rush to sell our winning investments to lock in that feeling of pride for making a good decision. But conversely, we hold on to our losing investments for far too long because selling them would mean we have to realize the loss and confront that painful feeling of regret. For an income investor, this could mean clinging to a failing company simply because its dividend hasn't been cut yet.
Overconfidence is another pervasive and really dangerous bias. When you survey professional fund managers, a statistically impossible majority, well over 50%, consistently rate their own skills as being above average. This kind of belief leads investors of all types to underestimate risks, overestimate their own ability to control outcomes, and trade far more often than is actually good for them.
Now, if markets were truly random, you would not expect to find persistent patterns. Yet this long-term data from the S&P 500 reveals some very distinct seasonal anomalies. Just look at September, for instance, which has historically been the only month with a negative average return. These are not just random fluctuations. They are persistent statistical patterns that present a direct challenge to the efficient market hypothesis.
So, how do we reconcile these two different worlds? The cold logic of efficient markets on one side and the observable reality of human behavior on the other? Well, a more recent theory, called the adaptive market hypothesis, attempts to bridge this very gap.
The adaptive market hypothesis, which was proposed by Andrew Lo, applies principles from evolutionary biology directly to finance. It views the market as a kind of ecosystem where investors compete, they adapt, and they're subject to natural selection. In this framework, those behavioral biases we talked about aren't necessarily defects. They're seen as evolutionary heuristics, or mental shortcuts that were once adaptive but might become poorly suited when market conditions change.
This famous quote really encapsulates the core tenet of the adaptive market hypothesis. In a constantly changing and competitive environment, maximizing your profit is actually secondary to a more fundamental goal. The strategies, and indeed the investors, that endure over the long haul are those that can first and foremost survive the inevitable cycles of the market.
We now arrive at the practical application. Because while understanding all these theories is intellectually valuable, the ultimate objective is to apply them to improve your own investment process.
To put this knowledge into practice, we can use a disciplined framework. This checklist, which is adopted from the work of Nobel laureate Daniel Kahneman, helps force a more rational process. It encourages a holistic view of your wealth, a firm commitment to a long-term plan, and a conscious effort to avoid the traps of short-term thinking and emotional reactions. And crucially, it demands that we confront the possibility of future regret and verify our own assumptions before making a decision.
This enduring piece of wisdom serves as such a powerful summary of our entire discussion. The real essence of rational, adaptive investing lies in developing the discipline to act contrary to the prevailing emotional tide of the market. It is all about maintaining your objectivity precisely at the moments when fear and greed are driving the actions of everyone else.
Ultimately, the question might not be whether markets are rational, but rather, how can we remain rational within them? A disciplined process, an awareness of our own psychology, and a primary focus on survival are the keys to long-term success. If you found this explainer valuable, please click like and subscribe for more insights from Finbot Insights, and consider this. In your own strategy, which is the stronger force, your analysis or your human nature?